Welcome to The Explainer. Today, we're digging into the Indian stock market. After this incredible run-up, it suddenly hit a pretty big speed bump. So the big question is India's growth story still on track? Well, let's find out. Okay, so for months, things were looking great. Indian stocks were on a tear, investors were feeling pretty good, and then July hit. Suddenly, the whole rally just seemed to lose its mojo, and the market saw a really big pullback. It left a lot of us just asking, what on earth just happened? And to put a number on it, we're talking about India's main benchmark index, the Nifty 50, right? This tracks the biggest companies in the country. It dropped almost 3% in just 1 month. Now, that might not sound huge, but after the run it had, that's a reversal that gets your attention. But, the real ouch moment was in the small cap space. These smaller companies, they're often a great indicator of how much risk investors are willing to take. And their index, it fell by a whopping 5.8%. A drop like that, it tells you there's a real shift towards caution happening. So let's get into what was really going on behind these numbers. To really figure out this drop, we have to look past the day-to-day market moves and get into the engine room of the economy. I'm talking about corporate earnings. How were companies actually doing right before this all went down? So the latest report card for companies, which covers that final quarter of the 2025 fiscal year, it paints a pretty clear picture. Top-line growth, which is just a fancy way of saying a company's total revenue, it was pretty sluggish. This wasn't some sudden collapse. It was more like a slow, persistent softness in overall demand. Okay, now this is where it gets really interesting. Look at this chart. While revenue growth was kind of meh for everybody, check out the profit after tax, or PAT. The absolute biggest companies, their profits went almost totally flat, up just 0.8%. But if you look at the broader market, profits grew by a much healthier 9.5%. That tells you something important. Smaller and mid-sized companies were actually finding ways to make money, even if sales were slow. You'll see terms like EBITDA thrown around all the time in these reports. Just think of it like this. It's a really pure measure of how profitable a company's core business is. It strips out all the accounting stuff, the tax rates, the financing costs, just to give you a clean look at performance. And the fact that EBITDA growth was stronger than revenue growth, it suggests companies were getting smarter and more efficient. So here's the kicker, the really crucial point. Even though the actual earnings for the last quarter weren't bad, in fact, more companies beat expectations than missed them. The professional analysts, the people whose job it is to forecast this stuff, they've actually been getting more and more pessimistic about the future. And that leads us right to the heart of the matter. If the recent performance wasn't a total train wreck, what's out there on the horizon that's making all the experts so cautious about what's coming next? We can actually track this feeling among analysts using a pretty clever tool. It's called the Earnings Revision Indicator, or ERI. And it's super simple. It just compares how many analysts are upgrading their profit forecasts versus how many are downgrading them. If that number is negative, well, it means pessimism is winning the day. And this chart just lays it all out, doesn't it? The ERI has been stuck in negative territory since late 2024. That means downgrades have consistently been more common than upgrades. Now, we have seen a little tiny improvement recently, but the overall mood is still pretty gloomy. The experts are clearly seeing some storm clouds gathering. But this analyst cautioned, that's only half the story. The other half is all about who's actually buying stocks and who's selling them. And right now, it's a tale of two completely different types of investors. So in July, we saw this massive split. Foreign portfolio investors, the FPIs, they got spooked and pulled over $2 billion out of the Indian market. But at the exact same time, domestic institutional investors, we're talking about Indian mutual funds, insurance companies, they stepped in and bought over $6 billion worth of stock. It's a classic tug of war between global fear and local confidence. And a huge reason for that foreign nervousness is the rising tension around the globe, especially the news of new 25% reciprocal tariffs from the US on Indian goods. That kind of trade friction, it just creates a ton of uncertainty about future profits, and that makes global money very, very hesitant. On top of all those global risks, there's a concern that's been bubbling up right at home: valuations. Put simply, stocks are expensive right now. They're trading at prices that are way above their historical averages. And as this quote points out, mid-cap stocks are especially pricey. They're trading at a 31% premium to the big guys, which is almost double the usual 18% gap. That's a big deal. Okay, so while the market is wrestling with all of these challenges, something huge just happened on the policy front. A massive domestic policy change has just been announced that's literally going to shake up entire industries and create a whole new set of winners and losers. The government has just announced a massive overhaul of the goods and services tax, the GST. And these changes are pretty significant. We're talking about taxes getting slashed on things like everyday cars, cement, TVs, ACs. That's a huge potential win for companies like Maruti and Voltas. But at the same time, taxes are going up on things like bigger motorcycles and coal, which creates some real headwinds for firms like Eicher Motors and NTPC. But the key here is to look at the big picture strategy. What's the goal? By making a whole range of goods, everything from cars to soap, cheaper for you and me, the government is trying to spark a whole new wave of demand. This is basically a direct shot in the arm for the domestic economy, trying to get it going from the ground up. So what you have is this really complex picture, right? You've got global risks and high prices on one side, but a huge domestic stimulus plan on the other. So how are the experts playing this? Where do they see the opportunities? Let's take a peek at how one of India's biggest asset managers is set up. They're overweight, which just means they're investing more heavily in sectors that are directly plugged in to that domestic story. They like financials, who'll benefit from more people borrowing. They like pharma, and they really like consumer discretionary sectors. Think retail, hotels, travel, which could all get a massive boost from lower taxes and more people spending. And they're looking beyond just sectors. They're focusing on these big, long-term structural stories. Things like the massive investment happening in renewable energy, the big push to make India a manufacturing powerhouse, and the modernization of the country's power grid and its defense capabilities. These are the kinds of multi-year trends that can just power right through any short-term market noise. And this brings us right back to that central tension in the Indian market today. On one hand, you've got some serious short-term headwinds: U.S. tariffs, nervous foreign money, high stock prices, and analysts getting pessimistic. But on the other hand, the long-term tailwinds are just so powerful. A huge domestic consumer base, tons of local money flowing in, and now, these major tax cuts designed to pour fuel on that fire. So what does it all mean? Well, while the road ahead might be a little bumpy because of all the global static, the fundamental, long-term story of India's domestic growth, it's not just intact, it's being actively supercharged. The big question is no longer if the engine will fire, but where it's going to fire next. And that's the story, explained.